Prateek Agrawal joins us, represents Motilal Oswal AMC. Let's understand his market view and where he thinks markets are headed for both ahead of the election and after election. Prateek, good morning. Thank you for joining us.
Morning.
Uh, Surprising, isn't it? We saw a big sell-off in the month of March, and then before the before markets realized that they've been hit with a solid volatility, the volatility is over. All major indices are at an all-time high. This market continues to climb the wall of worry. Will it continue to climb the wall of worry?
No, incidentally, we had a conversation on the day, on a very bad day in March. And even then, I had said that gold is up, Bitcoin is up, world markets are up, Indian large cap is up. In that context, if you see, the drop in mid caps and small caps in the country should have been an opportunity to buy. So that is one. Second, the positivity that you see in the market, starts from positivity of corporate India. Find us businesses, business leaders who are not positive about their businesses. I think that positivity is across all sectors. Managers can choose basis their inclinations, but positivity exists in the country across sectors, and it is being communicated to managers and research and let's say media houses like yours. I would believe you would concur. And when there is positivity in corporate India, if you get a correction, it has to be shallow. Now, one small math: if you get a 5% correction in a quarter, the way earnings momentum is, let's say 15, 16% earnings growth expectations over the next 12 months, you correct valuations by 10%. On the large cap index, mid cap is seeing a better earnings growth. So that correction is even higher there. So look at the dips in the market in that context, and one would understand that in a period when earnings growth is strong, dips should be bought in. Those are godsend.
When we spoke to you last, we referred to your position in banks where you were underweight. Banks have underperformed. Is it time now to check that position? Because that's one consensus trade which everybody has where you are positioned on the other side.
No, so very, very proud of my team. We have very good guys on the financial side, and we had this conversation internally. See, in the marketplace, banks are over 30% of the index. IT is another 12% of the index. So close to 50% is these two sectors. If you get these right, you will look good on performance, else not. And last year, we discussed, we said bank profit growth. Remember 4 quarters back, you were having banks account for 40% of a quarter's total earnings and deliver you 40% YOY growth, kind of a number. We said this is going to decline over a period of time because one, the deposit costs are going to go up, and at that point in time there was this expectation that middle of this year you will start to see lending rate declines as rate cut cycle sets in. It's got postponed for sure. But there will be NIM compression, and this profit growth leadership that this space has, slowly, surely would be a thing of the past. Coupled with that was a situation where there were regime changes in some of the larger banks. So we opted to be lower down on banks significantly versus the index. Now, some of the concerns, there are incumbents, new guys who have been there for some time, settled in. So to some extent, one problem is getting sorted, but the NIM squeeze thought is still ahead of us. So this quarter expectation is that bank profit growth would be just about index. Over the next 3, 4 quarters, maybe you would see a quarter wherein bank profit growth is lower than the index. So with that thought, yes, we are looking at it again. Prices have dropped, valuations have dropped, but we have not been nibbling in as yet.
Looking at buying banks, and what are you looking at selling? Because you'll have to make space for something to get out or something to get in.
Absolutely. No, so that is what I said. We are looking at it, but not as yet buying. I have not seen any of my managers increase banking sector exposure. The thing is, profit growth leadership lies in another part. Very simple way of understanding is, go back to 97. What a software did for us over the next 7, 8 years is what a slew of businesses are doing in the present. It could be EMS, it could be EV, it could be, for example, hospitals, it could be luxury and so on and so forth. So, a whole slew of businesses, many of them with a very strong backing of policy making, is where the earnings growth momentum lies. And we are a growth focused house, quality and growth focused house. So in our portfolios, you shall see a lot more of the newer spaces, spaces which are very, very aligned to the aspirations of the country, the direction of policy making.
Right. Pratik, the other thing, of course, is the election event, right? Which pretty much seems under control for the market and something that they've already priced in, and even a number of seat is what's being already talked about. You think the bigger trigger is going to come in from the budget, which is going to come thereof? And what is it broadly that the market is anticipating from that?
No, so the good thing is, as per current expectations, we see continuity, and continuity of policy makers should also imply continuity of policy making. So, negative surprises should not be there. Focus on capex should be there, and continuing. Focus on defense, given the geopolitics, should be there. We have embarked on a very strong Make in India initiative. So, for example, something like electronics, cell phones, etc., are getting manufactured in the country, I should say, assembled in the country. Now is the time when the ecosystem in terms of components, etc., start to be set up. So we do expect, policy to continue on its course and build up that ecosystem. It is a multi-year theme. Once again, I would say if we have to take some lessons from the past, look at what was capex to GDP, gross fixed capital formation to GDP in 2000, 2001, and where it was in 2008. We are seeing something similar happen from very similar levels from 21 onwards. So we have had 3 years of gross fixed capital formation increase as a part of GDP. We do believe we have several more years going forward. So if you then translate into our portfolios, you would find a lot more of Make in India versus consumption. Consumption as a part of GDP has been losing. It may be growing on its own, but losing as a part of GDP, that could continue for several years.
Let's also get in a take then when it comes to the entire auto and auto ancillary space. How is it that you're looking at the long-term prospects within the sector in light of the fact as well that, we have been seeing the introduction of EVs, a lot of newer models that have been launched?
No, so very simply put, EVs is a disruption for the space. In every disruption, newer winners emerge. Okay, so our thought has been to look at very capable companies who may not have succeeded as well in the ICE age. And well, if they do a much better job in the EV space, they can make a large difference because, it's not that. So one will reduce to our mind, the other will come up. Overall, for the industry, it is replacement. But the guy who gains market share in the EV space shall do much better in the markets. So we see that opportunity in a two-wheeler company, which as a house we do own. We see that opportunity in one of the four-wheeler companies, which as a house we have missed.
Prateek, if everything is so great about India, why are FIs selling? They have the same data point, they get the same GDP data, they have the same points in terms of earnings and valuations, but the way they are selling, it clearly appears that it is more than just a country allocation.
No, so one should to look at look at 12 months of what FPIs have done, India and other countries. Okay, if you find them selling more in India, more consistently, more number of months out of last 12 months, then what you are saying is right. But if you find them selling less in India versus other geographies, then the selling that you are seeing is probably on account of them losing monies in their funds. So, I may be very positive on the country, but if my fund loses money, I have to sell. Same is the case with FPIs. Okay, when I looked at that data, I thought they were positive on India. And in fact, while other countries were seeing a lot of selling, we actually saw net buying for more number of months. Now, start point is also important. You should look at India allocations versus where MSCI is. I think you would be pleasantly surprised. It has been going up in FPI books. So that is one thought. Second, why are they losing money? Well, if the interest rates in the US stay so high, imagine a wealth guy going there and making a pitch to an investor saying you should put money in an India fund or an emerging market fund. Now, emerging markets are not really nice just now. I mean, you can't put in Russia, China. Markets are very cheap, but they don't seem to be performing and sustaining. Every time they perform, it is a flash in the pan kind of situation. And India funds themselves, if you look at India fund managers, most of them would be getting money. But if you look at emerging fund managers from whom we get most of our inflows, that as a pack is not getting money. That as a pack is a reducing pool of money overall.
Appreciate your time.
So next
Yeah.
point, India story is about Indians. Is about Indians getting slightly richer versus earlier. Per capita are increasing. Look at what is happening in Malaysia, Thailand. How much of their wealth is into mutual funds, into the markets. We have started on that journey. It's a multi-year journey. China was recipient of FPI in 2008. It moved in line with global markets. It's now the biggest FPI globally. Even if we are 15 years behind, that same thing is happening in India now. So this is the time when we focus on domestic money more than FPIs. The only fear is just when the focus on capital markets is increasing, we should not do anything which breaks the trend.
Well, appreciate your time. Thank you for joining us.
If you like this video, then like, share and subscribe to ET Now.